Tax reform, what is it? It's voluminous, it's wide-ranging, it will have a broad-based impact. For some, it's a tax cut, but for others, it's not. Some parts are permanent, but lots of others will disappear sometime throughout the next decade.
What tax reform is not, it's not simpler, it's not one size fits all, and it's definitely not something that you want to navigate on your own. What do you really need to know about tax reform? Filing your taxes on a postcard? Yeah, that didn't happen. However, each of the individual rate brackets has been reduced, and the standard deduction has been doubled, allowing many taxpayers to simply file using the standard deduction. Remember that personal exemptions are no longer available, and a number of individual deductions and credits have now been capped or eliminated.
For owners of S corporations and partnerships, there is a brand new pass-through entity deduction that allows these business owners to avoid tax on 20% of their business profits. There is a lot of details here, so talk to your tax advisor to make sure that you're best positioned to maximize this deduction and focus on areas like compensation, employee wages, asset purchases, business activities, and entity type.
Companies can significantly reduce their tax burden by claiming the new depreciation deduction. This is applicable for new and used assets on purchases such as machinery, equipment, furniture, computers, and software. Before business owners file their 2017 taxes, they're going to want to make sure that they have claimed all depreciation deductions that they're entitled to up to that point and take advantage of the prior higher tax rates.
The corporate tax rate was slashed from 35% down to a flat rate of 21%. This significantly impacts companies' deferred tax assets and liabilities that are on their books. Some other changes relate to net operating losses, depreciation, the deductibility of interest, and for companies doing business outside of the United States. Another change was the elimination of the corporate AMT. These and some other provisions in the corporate tax area are permanent.
The new tax rules will allow companies up to $25 million in gross receipts to claim things that were previously only allowed for much smaller taxpayers. This may allow companies to report on cash basis or stop accounting for their inventories. A common question from business owners after tax reform is, why don't I just become a C corporation and pay the 21% tax rate? Don't forget about the second layer of tax on dividends for C Corp owners, as well as state tax implications. These and many other concerns need to be considered as you evaluate what tax reform means for you and your business.